Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 223, Understanding Investment Products. Corey, welcome back to the show.
Thanks for having me.
The dreaded investment product episode, Corey. We hate investment products at Falcon Wealth Advisors. I'll be bold today.
Feeling bold. That's good. I like it.
Get it all out there. Get it all out there. Before we're going to go in, we're going to define products. We're going to tell you why we don't like them. We're going to tell you what's horrible about the industry today. So hopefully, if you're a current client or a potentially new client, you get a lot of benefit out of today's episode because, again, investment products are a lot of bad and not a lot of good, sadly.
If I just may add real quick, though, for the sake of setting the table and setting the tone for the show, I am of the belief, Jake, that not all investment products are inherently bad, but I am of the belief that there's a lot of investment products that you do not need to pay an advisor to buy for you.
Very good. Very good. That's a good segue into the show. In here. And again, thank you for tuning in, listening, or reading. Our subscriber count continues to grow every week. If you're watching this on YouTube, I would encourage you to subscribe and give us a thumbs up. If you're listening to this on your favorite podcast player, again, a thumbs up and a 5-star rating would be greatly appreciated. If you're not subscribed to my email, it's simply called Upticks. You can go to our website, falconwealthadvisors.com, hit subscribe. I think an email gets sent to Alyssa, who is our communications manager. She'll make sure you get added to my list. Corey has his own weekly newsletter called In the Money Insight. Same website, different subscribe button, but it's right there next to it. And he'll get you, or Alyssa will get you subscribed to Corey's weekly newsletter. Investment products are a huge part of the financial services industry. It's a billion-dollar industry, a lot of money changing hands, and a lot of companies making money. And so let's just dive right into it today, Corey. And the first one, probably, I would say this is probably the most common one that most people are familiar with, are mutual funds. And what a mutual fund is, it's an investment company that pools together investors' money and invests towards a common theme or goal. So every mutual fund will have what's called a prospectus that you can read. It's a legal document, a little booklet that outlays the investment strategy. So maybe they want to buy companies based in North America that are technology driven and grow their earnings faster than the average. They'll have some investment thesis, and they'll also lay out all of their internal fees, which are typically buried in these prospectuses. So you got to go digging for it. But the idea is typically the minimums are very low. So if you've got $500 or $100, you can typically buy into this pooled investment that will then go out and buy you shares of Amazon, Apple, Google, Microsoft, whatever the mutual fund owns. And now you're collectively invested together in this mutual fund with thousands of other investors. Did I explain that well, Corey? Did I miss anything on what a mutual fund is?
No, I think that was really good. The piece that I would add to that is that generally speaking, their mutual funds are going to be actively managed, to your point. I think you implied that, but to be explicit about it, typically a mutual fund is something where there is a manager or a team of investment managers for that particular fund or that strategy, and they're going to be active in terms of buying and selling securities that are held inside the pool of dollars that you mentioned earlier.
Right. Yes. And good point. So there's going to be a group of managers or one manager humans that are managing this capital on behalf of all of the investors. But typically they're very removed, right? So this mutual fund may have literally thousands of investors, but you're not going to get typically access to talk to this manager right there in their office in New York or wherever they're working. You know, they're managing the money, rightfully so. They're probably looking at the markets full time, and they're not typically, unless you have some special favor with the marketing rep, they're not typically directly involved with the client account. So if you have an IRA, for example, and you buy shares of a mutual fund, this mutual fund's not going to know anything about you. They're not going to know how old you are. They're not going to know your risk tolerance. They're not going to know when you're going to add money, when you're going to pull money. They know nothing about your financial plan, nothing about your family. They're just taking your dollars and applying their investment philosophy. That's it. And they're charging you a fee to do it. Now, I think it's Dalbar, Corey, that did a study on this, and I don't know how old the study is or if it's been updated lately, but for a long time frame here, it was something egregious. Like 80% of mutual funds underperformed their benchmark. So every mutual fund has like an index that they're tracking against, and 80% of these things underperformed, right? So if there's 10,000 mutual funds, that means 8,000 of them lost more money or didn't make as much money as their benchmark. Yet they're still charging you a fee for this, which is crazy. And so mutual funds are probably most commonly found in your 401k. That's where most people are familiar with them. You could also go direct to many mutual funds and just literally buy them directly through the mutual fund company. Or, and this is where we were going with this, Corey, they are advisor sold. And this is where we get a little, or I get a little fired up, Corey, is that an advisor sold mutual fund means that the mutual fund company is managing the money, they're investing the dollars, they're charging you a fee, and then you get Joe Schmo financial advisor is going to pitch this to his or her client, and they get paid a fee also on the mutual fund. Corey, why don't you talk a little bit about that?
Yeah, so the idea is the fund is going to have internal expenses, whether you buy it directly, whether you buy it through your advisor, or any other way. There's going to be fees for having your dollars invested in the fund. And that doesn't make it inherently bad, but there is a cost to do it, right? No one's going to do it for free, to be clear. Right. So if you are paying a mutual fund an expense ratio or a fee, and you are then paying an advisor a percentage of your assets or a fee to go and purchase that mutual fund for you, you are doubling up or layering up the fees there. And again, I don't think that any advisor that uses mutual funds is bad inherently, but I think that if an advisor uses mutual funds, they should not be charging a client an assets under management fee. They should be charging the client a flat dollar amount because they're not the ones that are managing the assets, and they shouldn't be billing that way accordingly. Right,
exactly. So there's two ways advisors can get paid on this. They can either charge you an upfront commission, right? So it'll be a one-time commission, like sometimes it's 5%, believe it or not. They'll charge you 5% upfront to buy this mutual fund. Or like Corey alluded to, they'll charge you an ongoing percentage, average, let's just say 1%.
Yep.
Now, a typical mutual fund fee is around 1% plus or minus, right? They're all different. And, I don't want to paint that with too broad of a stroke. But my point here in this example is if you're already paying the mutual fund 1%, and then your advisor slaps on another 1%, well, now you're paying 2% out of the gate every year. You are negative 2% before anything happens in the market. And we just don't see the value in clients paying us to take your money and go give it to somebody else to pay to manage it. And to begin with, 80% of mutual funds underperform their benchmark anyway. So you're right, Corey, I shouldn't be so hard on them. If somebody is doing this on their own and you want active money management, you want somebody doing it, but you don't want to hire an advisor, then maybe you can go directly to a mutual fund company, or maybe they're doing something esoteric like investing in Zimbabwe, right? Or they're buying artificial intelligence stocks and you don't want to have to research those stocks, but this mutual fund, they have a specialty in doing something that you have an interest in, but you don't have the knowledge in. Like for those unique circumstances, I can kind of get it. Only for the individual. Again, we don't use mutual funds at Falcon Wealth Advisors because we're in the business and we do this every day. But I think as an individual, Corey, do you agree that if you wanted something a little bit different and unique and you didn't want to have to buy the stocks and you wanted someone to actually manage it, then maybe going directly to a mutual fund's not so bad?
Yeah, I think that's literally the spirit of the creation of the mutual fund is what you just described. It's a way for investors that may not have as much money to be pooled and diversified into a bunch of companies that they either don't have the time, energy, desire, or resources to try to research themselves. That is the point. I think that's why mutual funds were created.
Right. Or you're starting out small, right? You might not have enough money to go buy a diversified basket of stocks of Amazon, Google, Apple. Those are all somewhat highly priced stocks, you're not going to, if you're starting with $500, you're not going to be able to buy all those shares typically, unless you go into fractional shares, which is a whole other issue. But so again, it's a way for the small investor to get diversification and again, have a money manager manage it for you directly, which again, isn't the worst thing out there. It's just, again, the issue is an advisor charging you a fee on top of it, to me, is somewhat reckless. Now, if you want to have an advisor and use mutual funds, Corey, you mentioned this, pay the advisor a flat fee. Pay the advisor $100 a month or $200 a month to be your advisor on planning, tax planning, financial retirement planning, to do that stuff.
Yep.
But don't pay them a fee to invest your money, because they're not investing the money. The mutual fund is in there. Right. So again, and then again, so tips on how to look at mutual funds, because again, we don't buy them, but some tips on understanding them when you're selecting a mutual fund. I think the number one thing you want to look at, believe it or not, before fees is their track record. What we typically recommend clients do is they look back at least 5 years, and they take a look and they see over those last 5 years, is the manager beating their index? Because then they're actually adding some value there. Right. So if you're beating your index over the last 5 years, that's probably a good check mark of something that maybe is leading you towards making a good decision. You want to see if there's been a lot of turnover on the team. So if they had 5 years of outperformance, but let's say they've got a brand new investment manager or team in there, well, then that performance really isn't that new team. So you want to be cognizant that the team has stayed intact. And then obviously you want to look at the fees. But again, if it's worth paying for, if they're beating the benchmark and they're charging you 1.5%, and you got a cheaper fund over here, but they're underperforming, well, it's okay, in my opinion. So again, you want to know what the fees are and what you're paying. I don't want you to be ignorant to that, but you want to look at, typically we advise, look at that 5-year track record. Are they beating the market? And then you want to understand what is their investment philosophy and how are they diversified? Because real quick, Corey, before we switch gears, a mutual fund, right, will have a specific style, large cap growth or whatever. But if you buy 10 mutual funds and they're all large cap growth, you may not be diversified, right? So you want to know what is their specialty, what box, for lack of a better term, are they trading in? And then if you want to get more diversification and you want to go buy another mutual fund, then you'd go look for somebody that's in another box, right? And you want to try to fill up the boxes as well as you can to be diversified. Again, this would be for a do-it-yourselfer, but I just want you to understand mutual funds are investment companies, pooled dollars, typically for the small investor, not our clients, that want diversification. And we do not recommend paying an advisor a fee to buy a mutual fund. If they want to charge you a one-time consulting fee or an ongoing planning fee, that's okay. But don't keep paying them a fee for me, because you're double paying. It's like paying someone, and maybe this happened. This is probably before our time, Corey, but I think gas stations used to have someone you would pay to put gas in your car, right? It was a gas station attendant, right? And maybe it was a little concierge service. Maybe they'd wipe your windows or check the air in your tires, right? But now when you go to gas stations, you pump your own gas, right? So our argument or our thought is that the middleman can be cut out here and you can pump your own gas. You just have to do some due diligence, or maybe say, hey, Joe Schmo, can I pay you an hourly fee to give me some advice on mutual funds? Can you give me a couple hours? Give me some advice. I'll write you a check. I'll pay you for your advice, but then I'm going to go do it, right? Or whatever. So you don't need to be paying an ongoing fee to pump your gas. Maybe someone shows you how to pump your gas the first time, and then you kind of got it figured out. Look at my analogy.
I like it.
Well, thank you, Corey. All right. Anything else on mutual funds before we move on to the next product?
I'm ready to move on.
The next product is similar to a mutual fund. It's called an exchange traded fund, also known as an index fund. These are very similar, but the difference is they're typically unmanaged. So when you're buying an index fund, you're buying the whole market, right? So if you buy an S&P 500 index fund, the goal of that index fund is to own all 500 stocks in the S&P and be weighted accordingly, if that's what its objective is. Now, one of the pros against a mutual fund on this is that the costs are typically a lot less. I mean, the cost can be almost zero for some, or there's probably very few that are free, Corey, but maybe 15%, 15th of 1%, like a 10th of a percent, right? Pretty low cost on these, because again, no one's driving the ship. You're just riding the index. Corey, who are these good for?
That's a good question. I think who these are good for. Typically my advice for someone, if they were going to buy these, like who I think that would be appropriate for, maybe if somebody was just getting started out and they wanted to have money invested in the market, they didn't want to be hands-on and they didn't want to pay someone too much money. They just wanted to have exposure to the market and, have the accounts, have the index funds or the ETFs. They're going to do what the index does. So if you just want to have exposure to those indexes, and you don't want to have to pay a lot of money to someone to get that exposure for you, that's who I think they're for.
Yeah, so you're right. You don't want to pay for it, and you subscribe that you understand that 80% of mutual funds underperform the market. So you're like, look, if I don't want to have to go pick the 20% that do better, I'm just going to buy the market, and I know I'm going to outperform most mutual funds if I do this. And it's low cost. And the other example, Corey, of someone that should use this if you want tax efficiency, because another thing I didn't mention, mutual funds will have capital gains distributions that are basically forced tax events when you own a mutual fund, unless you swap out and do all this other fancy maneuvering, where an index fund doesn't typically have that. So again, they're good for tax efficiency, low cost, and for someone that subscribes to passive management, meaning you basically have subscribed to the thought that no one can beat the market, so I'm just going to own the market. And that's what I want. If you notice, though, in our description here of who should own this, it is not someone working with an advisor. Because again, I don't think you should be paying an advisor an asset management fee to buy an index. So if an advisor is charging you 1%, regardless of what that index fund is charging you, you're going to underperform by 1%, if you can follow that, because nobody's managing this index. So if you buy the S&P 500 and you pay an advisor 1%, well, you're automatically going to underperform the S&P by 1% every year. Guaranteed, which is a bad word. My compliance doesn't like that, and maybe that'll get edited out. But my point was, you're not going to, and in the next fund, you're just writing the index, and it's negative 1% because of the fee, is what I'm getting at. And if you're paying an advisor, there's no way to make that up. If nobody's managing the index and you're paying a fee, you're locking in that 1%. Corey, did I explain that well?
You did. I would never pay an advisor if I knew that cost was going to result in me underperforming the market. I would rather pay an advisor to try to pick the mutual funds in the 20% that outperform their index. I would rather pay an advisor to do that than to just go and buy an index fund for me and ensure that I underperform. You talked about a Dalbar study earlier. I'm going to speculate here on a Corey Bittner study of advisor managed ETF portfolios. 100% of them underperform the index. Exactly to your point, Jake, because there's a cost involved.
You know what bothers me a little bit, Corey, and we can debate, or maybe not debate this, but I'm curious, why do you think so many advisors use them and charge a fee? I mean, I think, I don't know the numbers on this, but I think index funds are probably more popular than mutual funds now, but advisors are still charging 1% to manage it. So I'm talking about millions of people are underperforming the market every year that are using advisors that are using index funds, and they're okay with it. I don't understand how the industry has gotten so sideways to make this okay, for clients to be okay with that. Do you understand? Like, I mean, it's not a debate. Maybe you agree with me, but I mean, do you have any explanation or thought of why that's happening or why that happened?
Yeah, that's good. So I think it's been recognized, this is just my perspective here, but over the last, 1 to 2 decades, particularly, following the financial crisis up until, frankly, this year, 2022, the whole passive own the index strategy has worked really well. The S&P 500 has, it's performed remarkably well since the financial crisis. And it became increasingly difficult for active money managers to outperform what the index did. So I think in terms of why advisors do it, my short answer would be because clients are willing to pay for it. I don't think that makes it right necessarily, but that's why they do it. And I think it's a story to tell, to say, you know what, 80% of mutual funds underperform the benchmark. So why are we trying to pick active managers and pay these fund managers to underperform when we can just go own the index itself? Which I understand that story, but the The rebuttal to that, from my perspective, would be, why am I going to pay an advisor a cost, an ongoing management expense, to ensure that I underperform the benchmark?
Right. So yeah,
This doesn't make a lot of sense.
Yeah, for my call to action is for our listeners. If you're a client of Falcon Wealth Advisors, the good news is we're not using products, right? So you don't have to worry that you're getting double charged here. We're buying stocks and bonds and trading options for our clients. But my call to action is, if you're not a client, or maybe you are a client and you know someone that's not a client of Falcon Wealth Advisors, I would encourage you just to ask that person, do you know how you're invested? And if you're invested in products, are you paying your advisor a fee and the product fee? And I'm just curious, I would love to hear your feedback. And you can email me at jake@falconwealthadvisors.com. And Corey, if you want to send it to Corey at Corey, C-O-R-Y, @falconwealthadvisors.com. But I would love to hear the rationale, not from the advisor, because I know advisors can pitch it, like you said, and spin it and make them feel like the value. But I want to understand from a client perspective why you're comfortable double paying. Like, why are you okay with paying an investment product fee and an advisor fee for one service? I would love to hear an advocate from a client perspective, because our clients, I don't hear that because we don't do that, right? And I would just love to hear that. And I know advisors, like you said, they could say, well, blah, blah, blah. But I just think any advisor that does that should not be charging an asset management fee. They should be charging, and if they're only managing assets, then they probably shouldn't be in this business, because you're not managing assets. So then you have the other side of the equation, which is what many advisors do, is financial planning and investment. So you should be doing some sort of financial planning fee, as far as a monthly subscription or a quarterly fee, however you wanted to do it. But it should not be based on the value of the account, because you're not managing the account, right? And shame on the advisor that is doing that still, because I don't agree with that. I think we charge a percentage of assets we manage, but you know what, Corey? We're managing the assets, right? We are deciding which stocks and which bonds our clients own, and we are managing that. So we are, for lack of a better word, the theme of our show, we are the investment product, right? And we're also the advisor. What's great with our clients is they're getting all of that in-house at Falcon Wealth Advisors, and our team of 15 professionals are working very hard to provide that product and service. So the product is our investment performance, and the service is the financial planning and everything else that we're doing. So we're doing all of it here. And shame on the advisor, Corey, that is I mean, you're going to charge somebody 1% and then outsource it? Like, what are you doing?
What value are you at?
I don't agree with it, especially for the high net worth advisor, and for anybody, frankly, but especially for a high net worth. I mean, you have somebody with $1 million and they're paying an advisor 10 grand and a mutual fund 10 grand. They're paying $20,000, Corey, to get investment advice.
That mutual fund better do well.
Right. For here, they're getting that for roughly half that. And we're doing it all in-house. They're getting custom portfolios, stocks, bonds. So it's just like, why would anybody pay double for that? I just don't understand it at all.
No, I don't either. And this is clearly a topic that, Jake, you and I are both very passionate about. I'm sure that's probably
right.
Clear to the audience. But I just, for the sake of pointing it out, I think if we felt that we could buy exchange traded funds, or we could buy mutual funds for our clients and charge a cost to do that, and understanding those products charge a cost also, and we thought that if we felt that we would be doing better for our clients by doing that, we would. If we felt that we could do better for our clients, we would. So I just want to be clear on that. But to me, it's an industry issue that over multiple decades, our industry, Jake, has created a narrative that investing and managing money is complex, it's difficult, the cost of making the wrong choice is a big one, and therefore you need to pay someone a bunch of money to do it for you. That's just the narrative that's been created. But I think that the idea of paying someone a bunch of money to go and pick out investment managers or to go and pick indexes for you, that is an unintended consequence of the direction that our industry has gone over the last few decades. And in a lot of ways, I think that the investing public just doesn't quite have I wouldn't expect them to have the same perspective on it that you and I do. But I just want to be really clear about that.
Right. Yeah, and to clue in a little bit of the backstory, Corey, you and I originally used to use mutual funds. And so it's not like you and I both got licensed as advisors and knew this day one, right?
Correct.
It's the way, again, you're right. It's a byproduct of the way the industry has evolved over decades. And frankly, you and I got tired of underperformance in our clients' portfolios. We got tired of defending a third party that we had no control over. And we wanted to be fiduciaries to our clients. And in my opinion, we take fiduciary to a different level because we're not outsourcing asset management selection. Like I think you can be a fiduciary and do that, but you have to be very careful on the way you charge. But we're doing it all in-house. So like I'm literally helping make decisions, our team is, on what we buy and what we sell. And that's, to me, that is being a true fiduciary. That is really looking out for somebody's best interest. Because sadly, a lot of advisors don't even know what these mutual funds own. So not only are they charging clients, and they might not even know what the index fund owns, frankly, Corey. And they're charging clients a fee for this oversight, and they don't even know what's going on. And then the mutual fund and index fund are charging a fee, and it's just it's a big racket, in my opinion. I think the industry, I don't know what's going to cause it to burst or change. I don't even know if regulation will help, but I think transparency, I think it's time for the consumer to be informed. And hopefully people are getting this. Our clients already know this, but if you're a client, again, I encourage you to share this episode with your friends and colleagues because they may be getting ripped off, in my opinion, because they're double paying an advisor, right? And again, Corey, to be very clear, you're not saying advisors are bad. We disagree wholeheartedly with that methodology. I think as long as the client is informed and saying, okay, I know I'm paying mutual fund $10,000 and get it in dollars. I know I'm paying the mutual fund $10,000 a year and I'm paying my advisor $10,000 a year. Corey, I think that's worth it to me and I'm going to pay that. That's fine, right? But I would love to hear the rationale behind that because I could go to that client and say, well, what if you could get that for $9,000 a year? And what does that do to your portfolio over 30 years, right? What if you can get this very similar setup, if not better, for half of the cost because you're not using a product? That's it. Just not using a product.
Yep.
All right. So our third and last product here, because we got a little longer on the show, because my soapbox is big on this episode, are annuities, right? And you want to talk about dirty, Corey. Not only do you have, and I'm talking about variable annuities here, but not only do you have a mutual fund typically in the annuity, then you got a nice, big, fat, happy insurance carrier, Corey. Then you got your advisor. So now, we've kind of explained how you have the mutual fund and the advisor getting paid an annuity. They add a third component, the fat insurance company. So you've got investment advisor or investment manager, insurance company, financial advisor, all three getting paid on the client, Corey. Why don't you explain this one a little bit more, how that works?
Yeah, so the annuity itself is a contract between you and a life insurance company where you're either going to deposit a chunk of money up front or you're going to make a series of payments over several years. And in return, you are going to receive regular disbursements or actually an income stream from this annuity contract, presumably in retirement. And there's a lot of different annuities. There's a million different ways to do it. I don't think we need to go into too much detail on all of that. I think the idea behind it all is that, Jake, if I were to buy an annuity, if I were to pay for this insurance contract, there's a certain guarantee that I'm paying for. The reality is, if I'm paying the insurance company, the broker, the person who sold me the product, and then inside of the annuity contract, there's investments like mutual funds. And then inside those mutual funds, there's investments like stocks. The reality is I'm paying a broker, an insurance company, a mutual fund company to just go and buy stocks. And I think the reality is for somebody who buys an annuity or is going to approach buying one, you just have to be real with yourself and say, I am willing and comfortable paying an extreme premium for a guarantee from this insurance company.
And that guarantee is only as good as the insurance company, because technically the insurance company goes out of business, then you lose your money potentially.
Yep.
Good point, Corey. So I would challenge anyone that owns an annuity. And I want to ask you this, Corey, because we have lots of new clients. And again, I don't feel bad. I mean, I feel bad for the person, but I'm not judging anyone here. But many times clients are sold annuities, Corey, and they can't even tell you what it is. They don't know they don't know it's an annuity half the time. And the other half the time they know it's an annuity, but they have no idea what it is, what it's designed to do, what it costs, right? All they know typically, Corey, is that they were scared and they were told this is a safe place to put your money.
You'll like this, Jake. I got an email a few weeks ago from a client, and maybe they're watching this, and they sent me an email, and in the subject line it said, "Forgive me, advisor, for I have sinned." And then in the actual subject of the of the message said that they had a conversation with someone about an annuity and said, in a year like 2022, where the market's been highly volatile, mostly to the downside, stocks, bonds, all kinds of asset classes have gotten beaten up this year, the appeal of something that was going to eliminate all of that market volatility or concern was appealing to them. Understandably so. I get it.
Yes.
I get it. But they just said, can you really walk me through and help me understand why I shouldn't do something like this? And that's where I explained a lot of what we're talking about on the show here. And they didn't choose to go forward with buying it. But I did get a kick out of that subject line. Forgive me for I have sinned. But we got to talking about it. And I said that, again, it's just there's, broadly speaking, I'm a firm believer that anything that someone purchases an annuity to achieve for them, there's probably a better way to get to the same desired outcome or desired result, and there's probably a more cost-effective way to get there too.
Right. There's a very small population that annuity makes sense for. However, they are sold to a very broad population. And so, yeah, if you have unique estate planning issues, or maybe your net worth is so big that having insurance in your portfolio makes sense from a diversification standpoint, and I'm talking like 25 million plus or something, like, then you're right. Maybe some of these esoteric and unique products, remember it's a product, can make sense for you. But again, you're right, Corey, we have found many ways to achieve a very similar objective by not throwing on that annuity wrapper for our clients. We really want to hear, what is your desired outcome? And then let's talk about the options. But again, the best salesmen in our industry are annuity salesmen because the commissions are the highest. So just like financial services, typically the cream of the crop, slickest, smoothest talkers, Corey, are going to be the annuity guys, and they're going to get paid a boatload of money. And they're going to go there because that's where the highest commissions are, right? The money's not in being a fiduciary. Trust me, we get paid for what we do, but that's not where the money is in our industry. The money is in insurance, and the money is selling annuities. And that's where the best salesmen are going to naturally flock to, in my opinion. So again, you have to be careful with that. So again, you're throwing on wrappers, there's restrictions, there's all these things with this annuity. And I would challenge anyone that owns one if they could explain it, right? And sometimes, sadly, the salesman can't even explain it. People buy annuities from people for two reasons, in my opinion, Corey. One, they're scared, like your client, which is a recognizable emotion and something to be embraced and talked through. Or they really like the annuity salesman. Maybe you go to church together. Maybe he's your golfing or tennis partner, or you just really like the guy. Everybody likes him. He's the life of the party. Sure, Corey, I'll give him $100,000. I really like him. That is not what you should be making your financial decisions on. Likability is important. I think you should like your advisor, but that shouldn't be the only reason, right? You need to be an informed consumer. You need to understand what you're getting yourself into, whether it's a mutual fund, an index fund, or an annuity. You need to understand what the fees are. And I'm very proud of our process here at Falcon Wealth Advisors, Corey. It's transparent. Clients can pull up their account and see what stocks and bonds they own, and there's not some fancy name in their account of some product we bought them. And they don't have to worry about a prospectus and hidden fees, because we're not doing that. And I don't think you should do that if you're a high net worth individual. I just don't think you should be investing that way.
Yep.
Do you feel like we've been on a soapbox?
Yeah, I really feel like we have been.
I didn't mean to. The point of today's episode was to educate, inform. I like that point in the beginning, Corey. Not all advisors are bad. Not all products are bad. Today's takeaway is, though, we have a very firm belief in what we believe in is best for us, and most importantly, what's best for our clients. And if you're in a product and you're okay with it, that's great. More power to you and your advisor. We just think our argument is that most consumers aren't informed. And hopefully today's episode educated you, informed you. And if you already knew this, we would love for you to share this episode with your family, with your coworkers, with anybody, so that we can educate more people. Again, not to badmouth anybody. We just want to say, look, you need to understand that if your advisor is charging you 1% and a mutual fund's charging you 1%, 1 + 1 is 2, right? You take that 2%, you multiply by the money that's invested, and that's what you're paying. And if you're comfortable paying that and you feel like there's value there, then more power to you. Our argument is different at Falcon Wealth Advisors. We feel like you don't need to do that to accomplish a very similar, in my opinion, or hopefully better return in some circumstances. And that's what we do. And that's one of our key differentiators actually at Falcon Wealth Advisors, is that we don't use products. Corey, as we wrap up, is there any other parting comments that you have?
Yeah, just one more quick comment to make here in the spirit of, Jake, you and I not coming from the perspective of thinking that we know everything and that we've got it all figured out. I think the education goes two ways. And I really like that you pointed out what you did throughout the show, Jake, is that, if somebody has a specific instance where what we have described here today is not the approach that we would take and what we would do, but somebody has a very particular reason for why they've done something the way they have, please educate us. We want to hear it. I would love to know circumstances or situations where it has made sense for clients, because we don't think that we've got it all figured out. We don't think that we know everything, and we do remain open-minded. But we've learned also a lot over many years working with a lot of people, working at a big firm, launching our own practice, watching and studying the markets, evaluating investment performance for active managers. I've way more often than not, if a client comes into, or a new client comes into the office and has an annuity statement, it's usually, I don't know what this thing is. How do I get out of it? Right. It's, that's the truth. So that's why, frankly, I think part of the reason that I feel the way that I do, and you probably do too, Jake, is I've met with too many people over the last, 10 to
Hundreds.
12 to 13 years, too many people that have been sold something that they didn't intend to buy, or they didn't understand what they were buying, and they wanted to figure out how to get out of it. And sometimes especially with like annuities, there's a fee, there's a cost to get your own money out within a period of time, because that was the big fat commission that was paid to the broker that sold it. Like, when we evaluate all of that, trying to be as objective as I can here, it's hard to argue that makes sense for very many people.
Right. We literally have met with hundreds of people that have been sold products, and we have to do the work for the advisor that sold it, because they didn't do a good enough job. We have to tell them what an ETF is and a mutual fund and annuity, because the client doesn't even know. You're right, Corey. So we could continue on and on. One last comment here. There are other products that we didn't cover in today's show, like structured products, hedge funds, some different other pooled vehicles. Again, the key takeaway is you need to understand what you own, why you own it, and what are you paying, right? And add all that up. If it makes good sense to you as a consumer, feel free. And again, work with a fiduciary advisor, somebody that's acting in your best interest. That's very important for this. So thank you again for joining us. Thank you, Corey, for going on this rant with me. We look forward to doing more. We look forward to doing more episodes, and we hope all of you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.